Good afternoon or good morning if you're on the West Coast. Welcome to Q2's Richie May Trend Series. Today's topic is going to be mortgage headlines versus market reality. Um, as we go through this little housekeeping stuff, the webinar will be recorded and be distributed 1 to 2 days after this. And you can also download the slide deck from your dashboard if you want the slides. You can submit questions at any time via the Ask a Question function on your key on the dashboard. And we'll get to as many of those as we can. And if I can't get to them, all this, I'll respond to you after. And then feedback's valuable. So use those emojis, thoughts. Please take the survey at the end. It is important to try to understand what we're delivering and is it helpful. This could be a slightly different session than we've done in the past. As you know, Richie May, over 40 years on mortgage banking, dedicated to the mortgage banking process. Singular intent is to help our clients understand kind of the current market conditions and what's going on in the space. Got a whole suite of products out there for mortgage bankers and from the advisory side. And as always, we're focused on mortgage banking and partnership with many in the industry. I have the great pleasure today of introducing myself as today's presenter. Couldn't find anybody else to do this panel with me. No, just kidding. We're trying to do something a little bit different with this panel. I know that we've done, Tyler's got his own sort of podcast out there on the trend series on the market data. This is more focused as to kind of some headlines that are out there, trying to cut through some of the noise that's out there in the industry and try to give you some action items at the end of the presentation. So let's start with probably one of the stories that's chewing up a lot of bandwidth within your feeds, regardless of how you're digesting news these days. I am trying not to make any political statements, but I mean, I guess we're under a ceasefire with Iraq. It sounds like another 60-day temporary ability to negotiate. But what's going on in the market? Well, it's causing a lot of volatility. It's causing a lot of angst. Oil prices, which do appear to be coming down. But when I saw this headline, obviously on June 14th, like many of you, I was like, okay, well, what's this going to do to mortgage rates? What does this mean for mortgage rates? Well, we'll talk about that at the end to make you listen to this whole presentation. While we've learned more about what's under the MOU, it will be interesting to see how the next 60 days plays out. And is this really just kicking the can down the road, or is there a legitimate solution here that's going to cause whatever the new economy to look like in the second half of the year? So we didn't want to ignore sort of a big headline here. We don't have a lot. I don't have any answers for you as to what's going on. But at the end of the day, something to be aware of, and something certainly that has a lot of implications across the rest of the material that we're going to talk about. So let's get into some more headlines or some more topics. But before we get there, in the shameless plug department, for those of you that aren't playing bingo with us this year, the bingo card is out. And much like real bingo, and if you had the same bingo set I did as a kid, you know, you'd play bingo and then you'd find 076 in the sofa 3 days later, like, oh, I wonder why I didn't get bingo, because that number never came up. At the end of the day, we put a lot of stuff out at the beginning of the year that we thought was a potential possibility to occur in the mortgage space. Some of you may actually have won bingo already. So if you have, please email us back the completed cards at info@richiemay.com to win some Richie May swag. But at the end of the day, we certainly, as people say, and I've heard this multiple times in multiple medias, boy, I didn't have that on my bingo card. We certainly didn't have a war with Iraq on the bingo card. We had oil at $2.25 a gallon, not $4.50 a gallon. Though recently I've read it's below $4 now. So maybe we'll hit the $2.25 by the end of the year. But this was a bunch of information that we thought may or may not happen around mortgage rates, around things that can affect the mortgage industry. And some of this still has not occurred, right? We still haven't had midterm, the election results. We are in the primary season. That doesn't seem to be causing a ton of social unrest at this point, but we'll see what the midterm elections bring. And certainly Wells Fargo has not reopened its correspondent channel. But we should talk about banks maybe getting some Basel III relief. The MBA has been working very hard on trying to get banks Basel III capital relief. So again, a lot here. If you're not playing bingo, it's not too late. And some of you may have actually already won bingo. So if you have, please send us a completed bingo card, and Gabby from our marketing team will send you some Richie May swag. And we'll maybe put on another bingo card next year and see how that goes. When we start talking about some of the headlines that are out there, I think one of them that's real and cannot be ignored, though there is some caveats here, is the certain rise in FHA delinquencies. And a lot of this rise in delinquencies on the FHA side is really the result of a policy change along the loss mitigation strategy. So cutting through some of the headlines and cutting through some of the noise, you see a lot out there about delinquencies are rising, delinquencies are up. And yes, they are. But the reason why for many of the FHAs is actually because of this policy change around the loss mitigation strategy. That's not getting reported. And as I like to say to somebody, like, here's the headline, but the comma is, but it was expected. What we're actually seeing, believe it or not, on the FHA delinquencies on the 30s and 60 days, and again, May does not count because May had a crazy month end, i.e. short business days. But we're actually seeing less delinquencies in the 30 and 60-day buckets and more in the severe buckets, because all those loans that are in that trial mod period are getting pushed out in delinquencies, and we'll have resolution of those going forward here shortly. So yes, FHA delinquencies are up, but actually 30 and 60-day delinquencies are down. And that doesn't get a headline. What does that mean for servicers? Look, they're going through these trial mod periods. We'll see how hopefully those borrowers will be successful. If they're not, that's their one bite at the loss mitigation strategy, and we're going to see a rise in foreclosures. So you may see a headline next several months, foreclosures are up. And why? It's the same reason why FHA delinquencies are up. It's a change in the loss mitigation strategy. And what the FHA is trying to do is protect the insurance fund here and not have serial defaulters in their program. So is the headline real? Yes. Is there real implications for servicers? Yes. But is this the end of the world? No. This is really a strategic decision by FHA to change policy, and we'll see how it plays out. Hopefully it will be successful in the long run. And it may actually bring inventory, believe it or not, back to the market. Another headline that you'll see out there a lot of times is, boy, housing has appreciated, or housing is depreciating, or values are down. And yes, it depends on your metric and depends on what you're looking at. This is FHA purchase index, 1.7%. It's positive. However, it may be negative where you are. What we're seeing is a much more regional event when it comes to housing appreciation, housing turnover, and actually originations. Parts of the country are doing much better. Parts are doing much worse. The West and the South are not doing as well as what the former Rust Belt and the East Coast are doing. So depending on where you're originating loans, depending on where you've got origination, and depending where you got servicing, you may be experiencing a very different environment than what the national headline is. Has housing appreciation slowed? Yes, is the answer. Is it negative? Not across the board. It may be in certain markets. But again, this is another headline that gets a lot of attention, and people will use different metrics across different time periods to try to illustrate their point. What is the real reality here? We had unbelievable appreciation as a result of COVID. And that will affect that appreciation going forward. So, is this the end of the world? No. Is slowing housing appreciation the end of the world? No. Is depreciating housing the end of the world? No. But you should be aware of those risks in your portfolios. And we've got a question in, and I'll take questions kind of on the fly because everyone knows the train's really not on the track upstairs. Affecting FHA compare ratios? Yes, is the answer. We are seeing some people, well, first off, if you are experiencing elevated delinquencies in your FHA book, you should certainly get in touch with your Ginnie Mae representative and talk through it and explain to them that it's a result of the trial payment period as a result of the loss mitigation changes. And FHA has come out with some guidance around, hey, we're not really enforcing these ratios right now because of the fact we know this event was going to happen. But it never hurts to contact your representative at Ginnie Mae to talk through it, talk through what you're seeing, what you expect to see, because that open line of communication with Ginnie Mae or any of your counterparties is critically important. But to answer your question, yes, we are seeing FHA compare ratios kind of get blown out, and many people are tripping that 6% delinquency, severe delinquency number as a result of that change. But it's not the end of the world. Communicate with Ginnie Mae. They're aware of it, and just work through it with them. That's a great question. Again, it's sort of shuffling through that headline of delinquencies are at all-time highs. I couldn't help but pull something on oil prices. Not that I'm an economist or even know how to spell economics, but look, at the end of the day, $100 barrel of oil, and this was having a big effect on consumers. It's having a bigger effect on inflation. But the headline that you're not seeing is that oil is 20% lower from the highs. I mean, yes, it hasn't trickled through to the pump yet, and I don't know if it will. But at the end of the day, oil prices, as of pulling this as of June 15th at 7:41 a.m., crude oil futures were well off their highs and headed back towards where we were actually in March. And that's not getting a lot of attention. But what does this mean for consumers? This means more probably about consumer confidence, and they're willing to entertain buying a mortgage in the purchase market in the second half of this year than actually what it's costing them sometimes to fill up their gas tank on a daily or weekly basis. But oil prices are not at historic highs, and they've been real choppy. Every time there's a random tweet or of a peace agreement, you can see a lot of this noise around oil prices. So volatility is real. Volatility in oil is real. Volatility in mortgage rates is also real. All right, MSR recapture. This is the one that I should have probably checked to see who was on the call so I don't offend anybody and get too many threatening texts after this. But the EITF took up the topic and gave thumbs up that yes, a recapture can be part of the MSR cash flows or the MSR unit. And the FASB board during its May 27th meeting picked up this and said, yep, we agree, and they're working towards issuing more guidance and an actual recommendation that is supposed to come out in the fourth quarter of this year. So to be clear, right now there is a proposed change, but there is no change that's actionable at this point. Now, I've got a lot of issues with this recapture as it's being not defined. So the FASB and the EITF are not defining what goes into recapture. Is it the change of MSR value? Is it the origination gain that you're booking and pulling forward? So I think that this is going to create significant problems across the industry in the fact that there aren't going to be necessarily clearly defined metrics that people are going to have to do, and additional disclosure should not be required. That being said, this will continue to be an issue, I think, going forward, despite the fact that FASB is going to pass some guidance and put out a proposal letter here in the fourth quarter of this year. So I think it will be interesting to see how this plays out. Remember, right now, banks do not get to participate in putting recapture in their MSR value. A lot of non-depositories may be putting it in there. Yes, we're trying to reflect market values. But at the end of the day, I think recapture, valuing the MSR asset is difficult enough. Layering in recapture is going to create even more issues for comparability across folks. And I think this is just a way, quite frankly, that some people may just be able to book an MSR value that's just not realistic because they'll have a bunch of recapture value in there that may or may not be realized. If you look at the MBA forecast, mortgage rates are going to be at 6.5% through 2028. That doesn't, to me, spell a lot of recapture value if mortgage rates aren't going to go down from here. And I'm not predicting or I'm not saying that the MBAs would be correct, but I think people need to be very cautious when they start throwing a bunch of recapture in an MSR value and the volatility that can create based on where the expectation of mortgage rates are going. My further issue I have with recapture is recapture assumes that that MSR value is higher. And I could come up with dozens of reasons why it's not. But just think of, for example, a 69 basis point Ginnie Mae strip refinances into a 44 strip. There's no way that MSR value is positive. Think about a conventional loan that goes from a 30-year to a 15-year. That MSR value change isn't going to be positive. Think about a loan that goes from escrowed to non-escrowed. That's not going to be a positive MSR value. So I hope the industry is ready for the fact that recapture can actually be a negative MSR value. Now, if I start including gain on sale and other factors in there, well, then of course it's going to be positive. But if you're strictly looking at the MSR side and they're not defining recapture, I think this is going to create more headaches, not less headaches than we've already got today. I'm probably being a distinct majority in my opinion here, but I think this is not going to be the solution that people want. And I will actually predict that a mortgage company will blow up from including too much recapture income into their profile and not appropriately hedging their MSR asset. And at a quarter end, they're going to have a big miss. And that's going to create a lot of problems for the industry going forward. So I've already covered this, but here's just if you want some more data on why I think recapture is not always positive, there's a bunch of reasons why it's not going to be positive or always positive. Question, are you splitting out recapture from retention and the definition of each? So I think this is, again, where the industry sort of doesn't have a clear definition. I think recapture and retention get muddled into the same concept. So when I think the FASB is talking about recapture, they are literally talking about retention. And by the way, from an operational side, I think it's critical that if you retain servicing, that you have a portfolio retention or recapture strategy. Because even keeping a less valuable MSR asset is better than no MSR asset. But at the end of the day, it doesn't necessarily always mean it's going to be positive. So to answer your question, I think recapture and retention are probably the same number, i.e. you're trying to retain that servicing portfolio or recapture it. I think the industry uses both those words sort of interchangeably, and they probably shouldn't. All right, mortgage rates. I told Gabby, who runs our marketing team here, that this is where this presentation just may end, and they'll just have to like hook me out of here at 30 minutes. But inflation. If you haven't noticed, there's inflation out there, and yes, it's real. 4.2% was the inflation print in May. Obviously, core was less. I mean, if you take out everything that's volatile, of course, core is going to be less. But at the end of the day, this is well above the Fed's stated target rate of 2%. And here's where we are over the last 12 months on mortgage rates. And we've kind of almost come full circle. The war caused mortgage rates to go up, then they came back down. Now they're back up again. Look, there's the peace deal. We have already commented that. The expectation of mortgage rates going forward, I mean, I'm sure your capital markets teams had a fun day yesterday trying to decipher the Fed's comments from yesterday. For those that may have missed the first press conference by the new Fed Chairman Walsh, it was very interesting, to put it the least way. He wants to provide less guidance going forward, less clarity of where they're going, and they're going through a process where they're going to reevaluate the entire way that they're doing communications with the industry, which may include not having press conferences. If you read their statement, it won't take you long because there's almost nothing in their statement. It'll be interesting to see if they still release the minutes 3 weeks after the announcement. But a less transparent Federal Reserve means more volatile rates. And I think that the interest rate market is very much knee-jerk reaction to tweets, speculation, and other factors. Do I think mortgage rates are going to be at 6.5% exactly through the end of 2027 or the end of 2028? No, they're going to bounce around a little bit, right? Maybe go to 6, maybe go to 7. I don't think they go to 5. I don't think they go to 8. But at the end of the day, it appears that we're going to be very range bound. And if you haven't been paying attention to some of the headlines out of DC, boy, there's a lot more rhetoric about Social Security out there and how that's going bankrupt. All those factors to me don't lead to mortgage rates are coming down significantly. Doesn't mean they don't come down a little bit, but that doesn't mean they come down significantly. So when the war ended on June 15th or yesterday or today when they signed the MOA, mortgage rates are kind of like, we've already baked this in, not really moving around a lot. Boy, that long end of the curve awfully looks sticky. So at the end of the day, is the end of the war going to be a windfall for mortgage rates? I don't think so. I don't think they're going to come down 100 basis points. They come down a few basis points. I think at the end of the day, the U.S. debt, Social Security, and all of those other issues, and a less transparent Federal Reserve just means for your capital markets areas, for your long-term planning, that's going to be more difficult to predict rates. Therefore, it's going to be more difficult to predict volumes. Therefore, it'll be more difficult to predict profitability. And I'll give you some solutions at the end as opposed to just throwing out all these problems. Again, picked on, so I felt like I wasn't spending enough time talking about AI in any of my presentations. And so I quasi-used AI just last week to Google mortgage headlines just to see what is out there. And a couple, obviously, themes are present. Elevated mortgage rates. Well, okay, elevated compared to what? COVID, yes. Recent long-term history, no. Mortgage rates are actually at a great rate. 6 to 6.5% mortgage rate's a great rate. Forget the fact that you could have gotten to 3% during COVID. So again, even when you start to think about what some of these headlines are, you need to put them in historical perspectives. Buyers are shaking it off. There's increasing data and increasing trends out there that buyers are more willing to accept a 6% or a 6.5% mortgage rate. The turnover factor is there. They've been in homes for longer. They need to do something. They need more or less house. So you're starting to see buyers become much more accessible to sort of a 6 or a 6.5% mortgage rates. Certainly non-QM is a big topic. What's happening in that space is clearly a headline that we spend a lot of time, or everyone talks a lot of time. The technology piece is obviously out there. And then, believe it or not, servicing values actually came up on the AI search. The most valuable asset in lending and changing capital to retain customers in a volatile rate environment. I mean, even AI has picked up on the fact that servicing values are exceptionally high. What does that mean for you? It's harder to retain servicing. There's more best execution out there through aggregators that may be paying a great recapture value currently, even though mortgage rates, they may not be moving. So even the headlines sometimes are, I'd say, are somewhat misleading. But again, inflation spiking, mortgage rates went up a little bit. Really what's happening, I think, is the long end of the curve, all that uncertainty that's existing out there in the marketplace, whether it's the war, whether it's now a lack of transparency from the Fed, whether it's we don't know what the Fed's going to communicate in the future, all those are factors that just lead me to the fact that this is going to be a more volatile rate environment for a longer period of time. And there's probably no quick, easy solution. And on the home builder side, right? We always blame the home builders. Well, if they just built more homes, all this would go away. Well, most home builders today are publicly traded companies. There's been a major acquisition. Berkshire Hathaway bought Taylor Morrison in an all-cash deal. Okay, so I don't know a lot about Berkshire Hathaway and their investment strategy, but I could tell you this. They don't tend to buy at the top of the market. They tend to buy closer to the bottom of the market. What does that mean? Well, I think it means that probably for home builders, we're probably approaching the bottom, or at least very close to the bottom of their profitability and margins. And you may see more mergers and acquisitions in this space, as you tend to buy when it's cheaper, not when it's much more expensive. Regulatory burden. The House and the Senate are in a ping pong match back and forth with this housing bill for the 20 reform bill. Whether or not that actually gets passed as a bill, both houses have passed their bill. They're trying to reconcile it. There is some help there on affordability. There's some good stuff in those bills. There's some bad stuff in the bills. But whether or not that actually gets passed or not, we shall see. But the general thought is the House and the Senate sort of need to reconcile these things in order for one of these to pass. So we'll see what happens in that space, but it's something to pay attention to. Remember, the Senate side was trying to limit the number of investor-owned properties, which the home builders said, well, we're going to build less now. Well, that's not what they were trying to go for when they passed that bill. Affordability, affordability, affordability. Is it the rising costs? Is it rising insurance costs? Is it, how are we doing this? The builders are building slightly smaller homes and they're building them faster. That's how they're able to keep their margins. So again, they're addressing the market in their own different way. And it'll be interesting to see long term, where the general population of this country continues to migrate. The South and the West were hot. If you live in the Northeast, you're seeing a lot more fill-ins where they're taking those last sort of open pieces of land and building homes, because that's where there's a greater affordability than in other markets. So affordability and the entry-level challenges remain. So given all these headlines, given what's going on in the industry, what can you do? Well, the first thing I would recommend for folks is, if you haven't listened to Rocket's Q1 earnings call, you should. And I'm going to paraphrase, but Rocket laid out their massive mortgage company, and remember this includes Mr. Cooper, in kind of three verticals. And I think if you're in the mortgage space, it's important to think about these verticals in the following way. One, they outlined we have a vertical that's fee income, F-E-E income. So that includes some of their Realtor.com stuff. That includes their servicing portfolio. That includes their sub-servicing portfolio. So as they talk about their earnings and they talk about the stability of their earnings, and remember, they're a publicly traded company, they talk about we have a certain amount of fee income. Well, you don't have to be publicly traded to talk about fee income. How much on a monthly basis can you generate from fees that are outside of the mortgage origination space? You should know that percentage, and you should know what the percentage of that covers your fixed costs. Then their second vertical was there's a purchase market out there. And yes, it's seasonal, right? We're coming off of the high part of the purchase market, which is that late spring, early summer, and fall and winter are worse. But there's always a certain amount of purchase activity. And that's an amount of revenue that we can sort of count on, that we're going to get X percent share of a purchase market. And their final vertical that they talked about was the highly volatile refinance market, which they can't control to a degree because that's rate driven. But if you think about your mortgage business and you think about your mortgage entity, I think it's very important to think about those three verticals of income. How much of it is really volatile, subject to rates? How much of it is sort of steady stream, i.e. from a servicing portfolio? And what's your purchase share and how you're addressing this? I'll make a prediction that the Q2 earnings are going to look radically different than Q1 earnings, in the sense that many of the shops that had great earnings in Q1 were driven by a refinance business. And Q2 is actually a purchase market, and that's going to have a different metric for a lot of different companies. So I think if you break your company into those three segments and then layer in, if you've got servicing, what's the volatility of that servicing asset, you can have a comprehensive viewpoint for planning purposes around what's going forward in a highly volatile, highly energized market where we don't know where rates are going, we don't know where wars are going, and we don't know where oil prices are going. All we know is going to have volatility. So dummy it down, think about those in those three buckets: what's fee, what's consistent, and what's volatile, and understand your metrics and do your best to manage each one of those three silos going forward. That's all we've got for today. If there's other questions and answers, we can certainly go through them, but I think I kind of answered those questions on the fly. If you did like this format, sort of more of the random thoughts and just kind of digesting some headlines and trying to link it, please give us the feedback. But we appreciate your time. We appreciate you being part of the Richie May family. Hope you have a great weekend, a great summer solstice. Happy Father's Day, and we'll talk to you real soon. Thanks again for your time.